conversation from valuation towards asset management, and particularly towards what you guys now do as your core focus. And we've seen, especially throughout the last 12 years, how valuations or cheap valuations are definitely not enough to trigger the re-rating of a stock, and that there are other factors that have been confounding price dynamics in the equity market to a large extent. So I wonder if you might talk a little bit about how you incorporate, whether it's macro, this top-down approach for looking at triggers, or how it is that you bring on some trading considerations to this bottom-up valuation approach in order to not be confounded by some of these non-economic players and the ETF and the passive drivers that we have. Yeah.
Right. Sure. Well, let me start off with our central philosophy is there's two things that we don't want in a stock. We don't want to own overvalued stocks, and we don't want to own wealth destroying stocks. In other words, what we don't want is we don't want to own, and this is philosophical. So we started with Fama French in 92, then in 2015, they added profitability and investment as factors to their model, right? Philosophically, we have a big problem with what they did with the investment factor. Basically, the loading on the investment factor is negative, which says companies that are investing are going to generate negative future returns. And that derived analytically from a model of the firm where the price of the firm is equal to, in clean surplus accounting, net income minus investment, right? So kind of dividends minus investment. And in that context, the logic is take derivatives with regard to profit, take derivatives with regard to investment. Holding all else equal, more investment leads to lower returns. Okay. Analytically, what I think is really missing in that entire concept of the firm is the fact that you're not investing to not get future returns on that investment. So there's an interaction. Whenever a company makes a new investment, there's an interaction between that investment and the ROI. And that's completely missing in the analytic structure of what drove the investment factor. And what I think is amazing, and this blows my mind when you think about literally every significant quantitative value firm uses the investment factor. And what that says is I'm going to be biased against firms that are compounding wealth. If you're investing above your ROI, because you're investing, it's going to be a negative tension. Your profitability may be a positive tension, but I don't know how it's going to sign. And that's completely wrong. You want to buy firms that are compounding your wealth by investing in ROI greater than the cost of capital. I mean, that's just basically NPV finance.
So is it as simple as, or not as simple as, but if, for example, Fama and French had decided that instead of adding investment and profitability as independent terms in the regression, if they had added investment and profitability as an interaction term, where,
correct,
firms that are highly profitable and have high investment may have rated, that might have a positive beta, right? But obviously high investment, low profitability would be unattractive, right? Is that sort of simplification a reasonable approximation of the direction you're going there?
That's not a simplification. I'm a simple farm boy from a small town in California. That is exactly where we're going.
Okay.
Let me show you another slide on that quickly, because your intuition is exactly right. So let me just pop through and I'll show you what we call a wealth creation matrix. And it stems directly back from the concept of an economic margin and what we learned from working with managements. This is exactly it. Here on the bottom, you have economic margin, negative or positive. And on the y-axis, you have investment growth. And here's the thing. Investment growth is bad when you're earning less than your cost of capital, when you're a destroyer. If you're growing negative spread businesses, that's bad. If you grow a positive spread business, getting back to your term, because there is that interaction, it's not a static, take a derivative with respect to investment and it's negative. Mm-hmm. That interaction leads these sets of firms to be among the highest returners.
Interesting.
The entire industry has missed that concept. And
yeah,
They can
as
go
you
back
say
and
it, I'm
change
like,
it.
of course that's true. That's like,
Of course it's true.
insanely obvious. And I don't know how I've read that paper and, you know, have ruminated on it, written on it, explored it, you know, argued around it, whatever, all these years. And this unbelievably obvious piece didn't fall out.
You're not the only one, right? Look, rattle off any large quantitative value firm, and they've all incorporated the investment factor into their work. And I think,
Right.
I'm sure they'll all go back and there'll be a lot of revisionist history at some point as kind of our work becomes more popular and it becomes more widespread and accepted. But every firm out there in the quantitative value space has incorporated this concept of growth is bad. And they can justify it however they want, but it really is a fundamental misunderstanding of wealth creation and what NPV and what valuation is about. And it's an empirically driven coefficient that worked really well over a given time period that to me represents the worst, and it's just not good. It's not, to me, it's not a good development for finance that has become accepted to just keep adding on factors to try to explain asset price.